Hi, welcome to this video. This video is for preparation for exam for the enrolled agent exam, part one, individual. So if you're in the process of taking the first enrolled agent exam, which is for individual income tax, this video is for you. This is a deeper dive into the actual material. So it's not so much of just study tips. This is actual content that'll most likely be on the exam. So let's start with this. So this is question number one. Charles Moore had a $2,000 tax liability in 2023. In 2024, Charles expects to owe at least $1,500 in federal taxes. For 2024, he has not withheld income taxes. Which of the following statements is correct? So let's go through these carefully. So it's essentially, this is a question about estimated taxes. And it's going to be pretty common on the enrolled agent exam. So, whether somebody has to pay estimated taxes or how much they pay will be tested on the enrolled agent part one exam. So typically the rule is for estimated taxes, just to make it easier, it's at least $1,000 is due. So remember, the estimated taxes at least $1,000 due, $1,000 due. And then there's also the second part. So there's a part one and a part two to this, to answer this. So part one is it's at least $1,000 in tax liability. Part two of this is that the amount, if he paid less than 90% of the current or 100% of the previous. So 100% of the previous was $2,000. 90% of the current is $1,350. He paid zero. So that means, let's go through these now. So Charles does not need to pay estimated taxes because his tax in 2024 is less than his 2023 tax. There's no rule about that. That's irrelevant. That's not like a detail to consider. It's incorrect. Charles must pay estimated taxes because his tax in 2024 is greater than 1,000. Let's put that one on hold. Charles must pay estimated taxes because his withholdings are smaller than 100% of his expected tax in 2024. So what it's referring to is the 90-100 rule, the safe harbor rules. And the safe harbor rules are 90% of the current and 100% of the previous. But it's kind of mixing them right here. It's saying 100% of the current, and that's incorrect. And then D, not a shocker, but Charles must pay estimated taxes because withholdings are smaller than 90% of his tax in 2023. Again, it's flipped the other way. So it's 100% of the previous year, 90% of the current year, making this one incorrect, which makes this one correct. And this is slightly like a very, very slight difference here because it says Charles must pay estimated taxes because his taxes in 2024 is greater than 1,000. It's actually 1,000 or more. But again, the point is that that's the right one. And then you could, so that way you're not confused, you eliminate the other answers first, leaving you with this correct one right here. So at least $1,000, and then he's paid at least 90 of the current or 100% of the previous, but he didn't do any of those because it's zero, which leaves it with the answer B. Good. Now let's go to the second one. Michelle is a member of the U.S. Armed Forces and served in an active status in a combat zone declared by executive order of the president from January 25, 2024 through March 17. She returned to the U.S. and received her regular duty pay for the rest of 2024. What portion of Michelle's income is excluded on her W-2? Okay, so there is an exclusion, right? There is definitely an exclusion for when you're in a combat zone. For sure, there's an exclusion for that. Now, it's just a matter of what is the exclusion period? Like what point in time for Michelle is it excluded? So let's go through each one. So January 1, 2024 until December 31st, 2024. She was only gone between January 25 and March 17. So this is a safe one to rule out. The whole year isn't excluded just because she was gone for this period of time between January 25 and March 17. Let's go to the second one. So January 25, 2024 through March 17, 2024. Possible. Let's put this one on hold for now. So let's not choose that one, and let's also not eliminate that one. Let's come back to it. So and then the other one, January 1, 2024 through March 31, 2024. Again, let's put that one on hold. And then last one is all of the income is taxable, which means there is no exclusion, which would make this one incorrect to say that. There is an exclusion. Now we've narrowed it down to B and C. So what is the exclusion? The rule is that if Michelle was gone in January 25, then the rule is that all of January is excluded, all of February is excluded because it was through February, and it's all of the month of March. So any day you served in combat makes the whole month excluded, not the whole year, the whole month excluded. So this would be the correct answer. So all of January, all of March, all of February, all everything from January 1 to March 31st, all excluded. Of course, it's not just January 25 to March 17. It's the month of. That's how you'd solve that one. Let's go to the next one now. Okay, Millen is 39 years old. He's been divorced from his wife since March 1 of the tax year. They have two minor children. One lives with Milton and the other child lives with the mother. the children have been with their respective parents from March through December of the tax year. Milton provides all the support for the minor child living with them. The filing status with the lowest rate that Milton qualifies for is, so what the question here is asking you, it's asking you which is the best scenario for Milton. In other words, what's going to have the best tax advantage for him. And if you've been preparing the material, there's one that you can just right away eliminate instantly. And you can eliminate it for multiple reasons. Like very little thinking is required, and that is married filing separately, MFS. And why? Because they've been divorced, so they can't even file married filing separately, even if they wanted to. And then the other thing is, it's usually like the worst tax scenario, married and file separately. Typically, couples do that when they're about to divorce, or there's very like special circumstances, typically around legal liability of the tax liability, like avoiding that legal liability. Other than that, there are no tax benefits at all to marry and file it separately. As a matter of fact, it makes every tax consequence worse. It makes the standard deduction worse. It makes the credits, it eliminates credits. It enhances phase outs. It changes it kind of ruins your entire tax scenario when you do marrying filing separate. So that's not even an option. We can cross that one right away. The other one we can cross out is the obvious one, married filing jointly, MFJ. Why? Because in order to qualify for the status, you need to be married as of the last day of the tax year. So if we're talking about 2024, this couple would have been needed to be married for all of 2024 up until December 31st, 2024. But they weren't. They got a divorce. The only exclusion is, of course, if one of the spouses passes away in the middle of the year, for example. Like in this case, if he's passed away like March 3rd, the wife would still be able to claim MFJ or married filing jointly up until the end of the year because he passed away during that year. So it's kind of an exclusion, which leaves us now with either single or head of household. So another thing too you notice too is that head of household is a better rate because it's a higher standard deduction. But now it's a question of which one does he qualify for. That's a key thing too, is which one you qualify for. In any scenario, client asks you, which one should I do? Should I do single or head of household? The obvious answer is you do head of household. But again, it's not up to you. You need to qualify, and typically the qualifying factors are you can't be married and you need to have been taken care of a qualifying person for the majority of the year. So in this case, Milton was taking care of one of his children between March and December. That's the majority of the year. So he does, in fact, qualify for head of household versus single. And just to kind of give you a little bit more details, the standard deduction for 2024 single is $14,600. The standard deduction for head of household 2024 is $21,900. And essentially, the question is asking you, what's a better deal? What's a better rate for Milton? And that is, of course, to get a deduction, a higher standard deduction. So you choose head of household. All right, next one. Which of the following situations will disqualify a single individual from claiming the premium tax credit? So this is referring to the Affordable Care Act, ACA. And essentially, with health insurance policies, for people under 65, non-Medicare health insurance, there are subsidies involved. Like, for example, if you got a Blue Cross, Blue Shield, plan and it was $1,000 a month, but you qualified for an $800 subsidy, you only pay $200 a month out of your pocket, and the rest of it is a subsidy. So there's a big deal in the under 65 health insurance world. Now, the question is saying who can be disqualified from this? So let's go through each one and see. So marriage to an individual enrolled in a qualified health plan. It doesn't matter. You could be married to somebody enrolled in a qualified health plan. So that means you have a husband, wife. Husband, for example, is self-employed, doesn't have any benefits. And then the wife, for example, has a qualified health plan through work, but it just doesn't make sense to add the husband on there. So the husband goes out and gets an ACA plan, an Affordable Care Act plan. That would not disqualify the husband in this case from doing that. So we cross that one out. Increase in household income to 390% of the FPL, federal poverty line. The rule is 300% to 400% of FPL. So they're within that range. So that would not disqualify. We would eliminate that one. Inheritance of $1.1 million. So the ACA subsidy is based off of AGI. AGI is your adjusted gross income, which is a matter of essentially taxable income or taxable cash flow to you. If you inherit something, that is, inheriting something doesn't change your necessarily your income statement. It doesn't change your taxable income. It changes your net worth, of course. It changes your balance sheet, but it's not this question is not asking you about asset values. It's asking about disqualifying for the premium tax credit, and the premium tax credit doesn't talk about your balance sheet. It doesn't talk about the assets you own. It talks about your income. That's what it talks about. So this is completely irrelevant how much you inherited. No need to worry about that. If, for example, this was about how much you owned in assets or resources, then yeah, that would matter. But it's the premium tax credit is not about that. So, and then option D, becoming eligible as a dependent on their parents' joint tax return. Yes, that would disqualify you. So that means if you are, 22 years old, you're still dependent on your parents' joint tax return. You also want to get your own ACA plan. That's going to affect your credit because you can be claimed as a dependent on somebody else's return. Okay. Question 5. Lisa was married with 2 dependent children in 2024. Her husband died in April, and she did not remarry before the end of 2024. Which is which filing status would Lisa use for her tax return in 2024? So she could still do, if you remember from the previous one, she could still do married filing jointly, just to double check that one. She was married in 2024, and the question is, end of 2024, she didn't remarry. She could use MFJ, which is obviously a higher standard deduction than head of household, so we eliminate that one, much higher than single. Qualifying spouse is for the following 2 years after her husband died. So for the tax years of 2025 plus 2026, as long as she doesn't remarry in those 2 years afterwards. And again, the benefit of doing that is a higher standard deduction. Okay, which of the following situations is no return required to be filed in 2024? So the easy thing to remember is if your income is at least the standard deduction, then you need to file a tax return. Or, so I'll write it in right here. So it's at least standard deduction. Or net income from self-employment is $400 or more. So it's kind of a two-part thing. So let's go through each of these. So there's a table here. So there's a table right here that I added in. You'll need to remember a lot of this table actually. And the way you would remember this is you'd break it down like single under 65 equals 14.6. You'd want to remember that part. And then you'd want to remember single age 65 and older. It might seem a little bit intimidating to remember this entire chart, but it gets easier because you'll know, for example, like MFJ, you'll just remember that it's up there in the close to $30,000, and then just a little bit of a bonus if they are 65 years old. You'll remember that MFS, obviously, the worst filing status is like almost nothing for the standard deduction. So you get the hang of this. Just keep reviewing this chart and use flashcards to remember, and you'll remember this chart. So let's see. Let's go through each one individually. So married separate filing status. Okay, so we just went over this was $5, right? So this person the standard deduction is $5 for MFS. The question is asking you, in which of the following situations is no return required? There is a return required for A, so we eliminate this one. Option B, single filing status, single. So this person is single, under 65, gross income is 15,000. I believe the standard deduction for under 65 is 14.6. Yeah, it's 14.6. And then this person makes $15,000. So they're above the standard deduction, which means they are required to file a tax return. We eliminate this one. Married, filing jointly, both spouses under 65, gross income 30,000. Yes, 29.2 for MFJ. They're above that, so we eliminate that one. Which leaves us with this one is the correct one, single, age 70, and then we can just double check that one. So if somebody is single above 65, we come over here. So single above 65 is 16,550. This person makes 14.5. So they're under the standard deduction, which means they do not need to file a tax return. None of the answers here talk about self-employment income, but if your net self-employment income is $400 or more, then you're required to pay the tax and file a return. Okay, question number 7. Elvin is the ordained minister at his church. His salary on his Form W-2 is $20,000. He also receives $12,000 as a housing allowance. His housing costs for the year are $14,000. What is his self-employment income? So, okay, this is a little bit tricky, right? Because ministers and people who work at typically religious organizations, they kind of have a combination of self-employment income and regular ordinary income. And there's also a mix of like housing costs. So you're gonna need to break this down. This will be on the enrolled agent exam, so you need to understand this. So typically the rule is that there's a difference between self-employment income here and then the taxable income. I'll put the taxable income on hold. There's no reason to dive into that right now. It's just about self-employment income. So the rule is that all W-2 income from the church for the minister plus the housing expenses or housing allowance equals SE, self-employment. So that's 20 plus 12, which brings us to 32,000. it can't go above. He can't pay. It doesn't make sense for him to pay self-employment tax on the amount above his allowance. So he pretty much his housing expenses were greater than his allowance. So it would eliminate that one from the equation, the 14,000, and then it would also eliminate just the $20,000 one because it's not just the W-2 income; it's also the housing allowance. So just look out for that one. It's going to be a little bit tricky. Let's go on to the next one. Which of the following is the green card test? So essentially, this is this person here? The question is like the green card test is asking, is this person here lawfully? And just remember with green card, just remember that it is lawful permanent resident. That's what it means essentially. When somebody has a green card, they are allowed to live in the United States permanently. They can have a permanent address here. So that's what the green card. So it's not a matter of whether the person is a U.S. citizen or not. We eliminate that one. It has nothing to do with certified mail. This is just to throw you off. It has nothing to do with that at all. The green card test. Let's see what the last answer was. None of them are described. It is this one right here. So it's whether or not a taxpayer is a lawful permanent resident of the U.S. at any time during the calendar year. That's what the green card test is. So just remember, green card equals lawful permanent resident. It has nothing to do with citizenship. Okay, in April 2024, 2 months after Tori and Wendy finished constructing a silo on their property, it was completely destroyed by a tornado. Their adjusted basis in the silo was its cost, $40,000. That's how much it cost them to build that. It was not covered by insurance. The entire community has been declared a qualified federal disaster area. What can they do? What can they do from a tax perspective? So typically, there's the Tax Cut and Jobs Act, TCJA, and typically it eliminated casualty losses. So things like this would typically be non-deductible, except for if it was a qualified federal disaster area. So that's key. If this was not, then from a tax perspective, they wouldn't be able to deduct it. So they could. So just to make sure that yes, you could get a tax deduction for this. Also, it's covered. What's key, another key thing that's mentioned here is not covered by insurance. If it was covered by insurance, that would change this question a lot. It would change the answers a lot, the potential answers. So let's see, deduct 40,000 in either 2024 or 2025. So the rule is with casualty losses is you can either deduct the year of, which is 2024, or the prior year, so 2024 or 2023. This is asking they could do 2024 or 2025, which would be the incorrect answer. Deduct 40,000 either 2023 or 2024. That is the correct one, but let's see the other ones as well, just to make sure we're choosing the right one. Deduct 40,000 in 2023, 2024, or 2025. Incorrect. It's either the year of or prior year. And then no deduction in any year because the loss is personal. Again, that's not true. It is deductible because insurance didn't pay and it was in a federal declared area. Which of the following statements regarding extensions of time to file is correct? Okay, so let's go through each one by one. So which of these is correct? An extension request for a 2024 individual income tax return must be filed by August 15, 2025. That is incorrect, but let's come back to it. A penalty for late payment may still be charged even if an extension is granted. That is true. When you file an extension on your taxes, it is an extension to file, not an extension to pay. An automatic 4-month extension can be obtained by filing Form 4868. It's actually, this is also wrong because this is a 6-month extension, not a 4-month extension. And then an automatic 2-month extension can be obtained. Also, let me scroll down here. This is also incorrect, the last one, because it is a 6-month extension. So the correct answer is a penalty for late payment may still be charged even if an extension is granted. And then for the first one, the extension request must be done by April 15. So on April 15, you could file an extension or prior to April 15 of the tax year for a 6-month extension. And this will, of course, be for individual income tax. In 2020, Mr. Chang purchased 50 shares of common stock in Corporation D for $1,000. In 2022, Corporation D declared a stock dividend of 2 shares of its common stock for each 10 shares held. In 2024, D's common stock split 2-for-1 at a time when the fair market value was $20 a share. What is Mr. Chang's basis in each of his shares of D stock around to the nearest dollar if both distributions were tax-free and all the tax received was identical to the stock purchase? Okay, so this might seem really intimidating at first, but let's break it down one by one. So let's start with the first part. The first part is he took $1,000, right, and bought 50 shares, which means his basis is $20 a share, $20 a share. And then the corporation declared essentially a 2 for 10 or 2 out of 10, so a 20% increase. So he had 50 shares here, right? There's a 20% increase. He has 20% more shares now. That's 50 times 1.2 to arrive at 60 shares. So he paid 1,000 for 50, and then he's gained an extra 10 shares at 60 shares now. Still, the basis is still $1,000. That doesn't change that. And then a 2-for-1. So essentially, they took his 60 shares and then doubled it to 120 shares. So he paid $1,000 for 120 shares, which equals, you just do 1,000 divided by 120. It equals $8.33 per. It's asking here, what is his basis in each of the shares of stock? And it comes out to $8.33 per share. Which is the closest one would be $8 here. Which of the following statements is correct concerning excess contribution to a traditional IRA and the 6% excise tax? So let's say, for example, in 2024, the tradition of the IRA limit is $7,000 if you're under 50 years old. But let's say somebody just said, you know what, I want to put more money into my IRA, and they add in $7,500 and they're under 50 years old. Well, now they run the risk of the 6% excise tax because they put in extra money into the IRA. So $500 is exposed. So now the question is asking which of these is correct, which of these scenarios are correct. So the contribution only must be withdrawn by the date the taxpayer return is due, excluding extension to avoid the 6% excise tax. So this would actually be incorrect because it's not just the contribution alone, it's also the contribution and earnings would both need to come out. And then it's asking the next one, so we eliminate A. It's where the next one no. The contribution and any earnings on it must be withdrawn by the date the taxpayer return is due, or within 6 months of the due date, including extensions to avoid the 6% excise tax. So let's hold this one. That one seems like the right one, but let's come back to it. The contribution only must be withdrawn by the date. We earlier mentioned A is the contribution and the earnings, so this one also gets eliminated as well. Or else we'd be contradicting ourselves if we considered C. And then option D, the contribution and any earnings on it must be withdrawn by the date the taxpayer's return or within 6 months, excluding extensions. So also this is incorrect right here because it does include extensions. So we can eliminate this one. So remember, it's contribution and any earnings and including extensions. Now let's go to the next one here. Okay, so Jack, a U.S. citizen, was a resident of England for all of 2024. He received $130,000 in wages from an English corporation and paid taxes to England on this income. What portion of the $130,000 is exempt from U.S. income tax? So a couple of things here to remember, that even if you are a U.S. citizen living abroad, technically all your income is subject to U.S. taxes. But the good news is there's an exemption for that. For 2024, just remember the foreign income exemption is 126,500. So of the $130,000 he received, 126,500 of that is exempt. He only pays the difference in U.S. taxes, or the rest of that is subject to U.S. income taxes. It's kind of like so that way you're not paying twice the amount of taxes. So it's an exemption. Okay, question number 14. In 2018, Joan sold land for $100,000 that cost $50,000. She received a down payment of $30,000 with a balance to be amortized, meaning spread out over 10 years with an interest rate of 8%. In 2024, Joan had to repossess the property due to the failure of the buyer to make payments. Okay, so she sold it in 2018, and then about 6 years later, she had to repossess it over a 10-year period. So the plan was for the buyer to pay her back over 10 years, but almost halfway through the period, they defaulted and she had to repossess. So which of the following statements is correct? Joan has gift tax consequences and she has forgiven the debt owed to her. So the easy one to eliminate is this one right here because it includes gift taxes. There are no gift tax consequences. So that's the easier one to eliminate. So no gift tax consequences in this situation. And typically, no gift tax situations at all with installment sales unless you sell, for example, something at a lower price, less than fair market value to a family member. That could be construed as more of a gift than an actual installment sale. So that one's eliminated in this situation. The next one, Joan must figure the gain or loss on a repossession and has a basis of $50,000. So this one also, let's put this one on hold for now. Let's not choose it. Let's also not rule it out. Let's see what else is there. Joan must figure the gain or loss as well as the basis as a result of the repossession. So let's also put this one on hold. And then the last one, Joan has no tax consequences as she now owns the land. Also, this one incorrect, right? She sold the land. She had basis. She had gains. There was interest. So to say that there's no tax consequences, also incorrect. Now it's between B and C. So the correct one would be that she needs to recalculate or reassess the gain or loss at that point. She needs to look back. What's her basis? How much did she recoup in the sale? How much did she get back in interest? How much did she lose as a result of repossession? So this is the correct one. She has to reassess or recalculate the gain or loss in the situation. Okay, question number 15. Peter and Jill are married and file a joint return. So MFJ. In 2024, Jill was a media relations manager for a large firm and earned $232,500. Peter owns a graphic design business that showed a net profit of $500. In 2024, Jill was covered by an employer's plan. Peter was not. Their AGI was 23.5, which is a sum of $232,500 plus $500. What is the maximum deductible amount that Peter can contribute to a traditional IRA? So typically, in general, in 2024, you can contribute up to your earned income or $7,000 per person. If you're over 50 and over, you could do $7,500. So the question is asking how much can Peter contribute? So there are limits to how much you can add to your IRA based off this limit right here, plus another limit, which is based off if you are eligible or not for an employer plan. So it says that Peter was not eligible for an employer plan. Hence, he owns a business right here. That kind of gives it away. Jill was. So we start with Jill first. So Jill, the IRA limits for a covered spouse are $123,000 in AGI to $145,000. So if your income is under 123, then and you have an employer plan, then you can contribute up to either $7,000 or $7,500 depending on your age. If you are between 123 or so over 123 and then 145, then there's a phase out. But Jill is way past that. She's at $232,000. So Jill can put zero. She can't put anything into it. For Jill, it's zero. But the question is asking about Peter. But just to make it easier, I always do this just to go through both spouses, just to make sure you don't miss anything. So Jill is zero. She can't add anything. Now, Peter, when you are filing jointly, the phase out then is $230,000 to $240,000 for the non-covered spouse. So Peter alone is outside of this amount, but their combined AGI is $235,000. The limits are between $230,000 and $240,000. So there's a $10,000 phase out. They are about halfway through it. So they're at $235,000 in the middle between $230,000 and $240,000, which means that 50% of the contribution limit is excluded. So for Peter, it's $7,000. He can do 50% of that, which is $3,500. So you're going to need to know a couple of things. You're going to need to know the IRA contribution limits when you are under 50 and 50 and up. And then you also need to know the contribution limits, the phase out limits, when one of the spouses has an employer plan or the one that doesn't have the employer plan. So you need to know a couple of things for this question. And this will be on the enrolled agent exam as well. So the next one, question number 16, which of the following statements is correct for purposes of figuring and reporting self-employment tax? First one. So which of these is correct? If an employer has more than one business, the taxpayer must follow state tax law to determine if the net profits and losses are treated separately or combined. Let's put a hold on that one. If a taxpayer has more than one business, the taxpayer must combine the net profits and losses of all businesses. Okay, let's also put a hold on this one. If a taxpayer has more than one business, the taxpayer must combine the net profits of all businesses and separately combine the net losses of all other businesses. Also, let's come back to this one. If a taxpayer has more than one business, the taxpayer must treat each business independently. So this one, I'm going to just rule out. So it's not true. It's not independently. You actually combine. The right answer would be B. If a taxpayer has more than one business, the taxpayer must combine the net profits and losses of all businesses. And then just to add another note here, so just the difference between the rest of them, it's not separately, so we would eliminate that one. Then C, if a taxpayer has more than one business, the taxpayer must combine the net profits of all businesses, separately combine the net losses of all others. So this is also incorrect. So you net all profits and losses. And just a An additional note: if if the net income from all the businesses is $400 or more, then you're subject to SE tax, which is self-employment tax, which is essentially the payroll taxes for a self-employed person. Question number 17, Ron sold property for $10,000. The agreement calls for $1,000 as a down payment and a payment of $1,500 in each of the next 6 years to be made from an irrevocable escrow account. The escrow account contains funds provided by the purchaser for the balance of the purchase price plus interest. How is this transaction handled by Ron for tax purposes? So one thing that's kind of distinctive about this versus the other questions is the money goes into an irrevocable escrow account here, and it's to be made from the account. So that means that, let's go through the answer. So Ron would report the entire gain. Let's come back to that one. Ron uses the installment method to report the sale by electing to pay a special interest charge. So this one is incorrect. So usually that would be the case, but because of the irrevocable escrow account, the IRS looks at it as because the money was all paid at that time. Technically, it is essentially made available to Ron, even though it's an irrevocable escrow account. So we eliminate B. Also, we eliminate C. Usually, again, that would be the installment sale method too, but the irrevocable escrow account changes this question. And then D, let's also eliminate this one because there is one of these that are correct, and that is A. Ron would report the entire gain in the year of sale. And just remember, usually, if there wasn't an irrevocable escrow account, then what he would do is he would take his basis versus the gains. So let's just say, for example, he bought the property for $9,000 and then he sold it for $10,000. His profit is 10%. So whatever he received, so if he received a $1,000 down payment, 10% of that would be capital gain for him in the year that he received it. And then every year for the next 6 years, 90% of the 1,500 would be essentially a return of basis, and the other 10% would be capital gain. And then if there's interest, that would be like an additional taxable, additional taxable income to the client. So it would just be Ron would report the entire gain in this situation because of the irrevocable escrow account. So just look out for that key difference between this question and then other questions related to installment sales. Okay, question number 18. When Joe's financial institution offered a substantial discount of $5,000 for early payment of his mortgage, he borrowed from a family member to take advantage of this offer. The mortgage is the original debt from when he purchased his home, and it is the only debt on his home. How should Joe treat this discount transaction? So sometimes you'll see this on the enrolled agent exam. Sometimes there'll be situations where a lender will say, if you pay off the mortgage, there's a discount. So this is essentially similar to a cancellation of debt. So let's just say, for example, somebody had a loan with a company and the loan was for $10,000, and then you call the company and say, hey, I want to settle, or the company gives you the offer to settle, and they say, just give us half of it, just give us half the debt. So you owe $10,000. And then you pay $5,000 for that, and they close out the loan, they close out the debt. The other $5,000 is technically other income to you. It's taxable income in the form of a 1099-C. So the lender issues a 1099-C, so then you have other income now in the amount of $5,000. That's typically how it works. But let's go through these and see what's going on here. So report $5,000 original discount issue as interest income. Let's go to the next one. File Form 982 to claim the exclusion. Report option C, report $5,000 and Schedule 1, Form 1040, or reduce his home mortgage interest deduction by $5,000. So this is the easy one to eliminate right here. You don't do that. You don't reduce the interest deduction by the amount canceled. That's the easy one to eliminate, which leaves us with either A, B, or C. Now, option A would also be eliminated because if a lender forgives a portion of your debt, like they let you settle for a lower amount, it's not interest income actually. So even whether this is an exclusion for a home or not, that's not the correct way to claim this type of income. It would be on Schedule 1 as other income. That's the correct way to do it. The difference is, though, between option B and option C is that this is a personal residence and the debt was used to buy a personal home. So there's an exclusion for that. So in other words, the right answer is B. You file Form 982 to claim the exclusion. Now, if this was not a personal home, it was like if it was a company and then if it was any other debt and not a personal home, and they forgave some of the debt, then you would report that amount as, they would give you a 1099-C, for example, in the amount of $5,000, and then you would report this on Schedule 1, Form 1040 as other income. But that's not the case here because this is a personal residence, so we eliminate that one. And the right answer is option B. Okay, question number 19. A married couple who are both self-employed and work out of their home purchased a new home in August 2022 for $420,000. In September 2022, they converted 2 bedrooms into office space where they meet clients in their home. In April 2024, they sold their home, on which they had taken $40,000 in depreciation. Their home sold for $600,000. What amount of the gain is includable in their income on their joint return? So the first thing we do is we just calculate this as a normal business transaction. So they bought something for $420,000. That's their basis. And what do we know about depreciation is that it reduces basis. So then if you bought something for $420,000, you took $40,000 in depreciation, your basis now has been reduced to $380,000. And then they sold it for $600,000, which means there's a gain of $220,000. So that would be, we would just hold on this, but that would be the correct answer right here, option C, $220,000 as the gain. But then what do we know? What do we also know about personal residence? And a personal residence there's an exclusion. There's a section 121 exclusion, which means if you lived in a home for the last 2 out of 5 years. So if you've lived in your home for the last 2 out of 5 years, you can qualify for section 121 exclusion on a personal residence. If you are single, it's a $250,000 exclusion. If you're married filing jointly, it's a $500,000 exclusion. So in this case, let's see when they bought the house and when they sold it. So they bought it in August of 2022. And then in April of 2024, they sold the property. So it was less than 2 years. So they do not qualify for section 121 exclusion. So in this case, it would be option C. So we're going to treat this as a regular business transaction because they don't qualify for section, or sorry, a regular long-term capital gain scenario because they don't qualify for section 121. If they did qualify for section 121, their gain is $220,000. They'd be able to exclude $500K. So if section 121 applied in this situation, it would be option B. It would be 0 taxable gains or taxable income. But since it doesn't, it's $220,000. That is the taxable gain in this scenario. So look out for understand section 121, S121, and the rules around that. Okay, question number 20. Let's see. Yang and May, they're married, owned a fashionable handbag store in New York, which they report as a sole proprietorship on their individual return. So this means they use Schedule C. So it's not an S Corp, it's not a C Corp, it's not any other business entity except for Schedule C. So it's a key difference right there. They had gains for the following transactions during the 2024 year. $600,000 from the sale of a rare coin collection that May inherited. $100,000 received in accounts receivable from the sales of 500 bags in November 2024. $50,000 from the sale of stocks held in their personal account that were purchased in 2022. $5,000 for the purchase of supplies such as computer, paper, invoices, etc. used in the business. From the information provided, what is a total gross sales amount and characterization of capital transactions that Yang and Mei Ling should report for 2024. So in 2024, key items, capital transactions. So to answer this question properly, you need to know what a capital asset is. So a capital asset is any asset you own. So all assets are capital assets except for asset plus IP. What does that mean? Okay, so the A in asset stands for, so A is accounts receivable, C is copyright, I is inventory, D is depreciable business assets, and then IP is intellectual property. The C is already included in IP, a form of copyright. Owning a copyright is a form of owning intellectual property. So that's already included in there. I just did asset plus IP so you can remember it. So now we go back to the top now. So what is a capital asset? So let's see from here. Let's go through each one. So $600,000 of a rare coin, and she inherited, May inherited. Absolutely, this is a capital asset. So we count this one. $100,000 in accounts receivable. It is not a capital asset. So we exclude that one from this calculation. $50,000 of sales of stocks. Yeah, so a stock is not an account receivable. It's not a form of intellectual property. It's not inventory. It's not depreciable business asset. It's not a depreciable business asset. So yes, we include this one as a capital asset. And then $5,000 for the purchase of supplies such as computer, invoice, etc., using business, not capital assets. So now we're only calculating these two numbers right here. So $50,000 and $600,000. Now let's see what the options are for the answers. $650,000 is a long-term capital gain. Yes, but let's see what else is there. $695,000 ordinary income. No ordinary income. We're talking about capital assets. It's $95,000 as short-term capital gain, and then $50,000. So we could also eliminate $50,000 as long-term capital gain on the bottom, because why? Because the $600,000 inheritance, the gain from the inheritance, sorry, not the inheritance itself, but the gain from the inheritance, that one we eliminate as well. So it's more than $50,000. So easily we just eliminated 2 out of 4. $95,000 as short-term capital gain. Again, we just talked about the $600,000 one. That would leave option A as the only true answer. So $650,000 as long-term capital gain, and let's just check that. So long-term. So anytime you inherit something, it's automatically long-term. That checks it for the 600,000. And let's just double check the 50,000 right here. $50,000 from sale of stocks that were purchased in 2022, and this is 2024. So it's greater than 1 year. Remember, long-term capital gains has to be greater than 1 year, not 1 year, greater than 1 year. So it's a total of these two right here, $650,000 as a long-term capital gain. That works. That checks off. So let's go to the next answer now. Let's go to the next question. Okay, which of the following statements is correct for the deductibility of state and local taxes by using the optional state and certain local tax tables? If a taxpayer pays sales tax on the purchase of a new car. Okay, so what they're essentially asking here is there are itemized deductions that you can possibly qualify for either state and local taxes paid, so state and local, or sales tax. You can't do both. It's either one or the other. But let's see what the question is really asking us. So the taxpayer may use only the amount given in the table for the deduction on a taxpayer's return. A taxpayer may add to the table any sales tax paid on a purchased car for deduction on a taxpayer's return. So this is true. So this is correct, because if you're using the table, just remember, using the optional state and certain local sales tax tables, you can add any sales tax paid on a purchased car for deduction. So you can add to it, which means that if we can't, if we do 2, then we go back to previous one. A taxpayer may use only the amount given in the table for deduction. So that one eliminates itself because it contradicts the second one. So in other words, the first one is saying you can only use a table. That's it. The second one is saying you can use a table and you can add sales tax on there. And then the third option, a taxpayer may claim the actual sales tax paid as a deduction on a taxpayer's return. That is correct as well. So it leaves us with 2 and 3. This one won't be tested as heavily, but you just need to understand what it means to deduct sales tax. And then where that goes is typically part of state and local taxes subject to the SALT cap, which is in 2024, it's a $10,000 cap. For 2025, they've increased the cap to $40,000. And remember, you can't do both. You can't do sales tax and state and local taxes. Like, for example, if you pay property taxes and then you paid your state income tax for your state, it's either one of those. So it's either state income tax here plus property taxes paid, or sales tax. It can't be both of these. It has to be one side or the other side. And obviously, you would pick the one that fits mostly with your tax situation. So 2 and 3 right here. During 2024, Ms. Gonzalez paid $800 for real estate taxes on her primary residence and $600 on her mountain cabin. Her filing status is single, and she celebrated her 65th birthday on January 1, 2025. What standard deduction amount can Ms. Gonzalez claim on her tax return for 2024? Okay, so a couple of things to remember. So a couple of things to know about this. So number one, what is the standard deduction for somebody who is single? I have the table here. Let's go here. Okay, so single under 65 is 14,600. Remember that. And then single age 65 and older is 16,550. So it's either 14,600 or 16,550. Now let's go back here. So either 14,600 or 16,550. Which is the correct one? Let's see what the options are. Okay, so it's either 1650 or 17,550. We eliminate this one, and then we eliminate this one right here, 21,900, right? Because the question is either she's single and claiming the standard deduction. What is that amount? So here's the thing to you to know is what defines somebody's age. The tax year in question is 2024. And then her 65th birthday is on January 1, 2025. So the question is, was she 65 years old in 2024? The answer is no, she wasn't, because she turned 65 in 2025. So she falls under the under 65 single rates, which would be 14,600, not the 1650. And then just go back and check They threw in some other numbers here to throw you off, like $800 for real estate taxes paid and $600 on the taxes paid on the mountain cabin. Again, irrelevant in the situation because they're asking about the standard deduction. So that's how you solve that one. Question 23. Okay, so this nurse incurred the following expenses: $2,000 in attorney fees, $8,000 in gambling losses, $1,000 in purchase costs, $900 in union. She had a stereo equipment valued at $3,000 stolen from her home in 2024. AGI was $90,000. Included in the gambling winnings, $2,000. Now, very key question here. You need to zoom in here. For 2024, what is the amount of miscellaneous itemized deductions subject to the 2% of AGI limitation? So this is part of, so you need to understand TCJA, Tax Cut Jobs Act, and you need to understand the 2% elimination. So prior to TCJA 2017, some employees were able to deduct like investment fees, attorney fees, uniform costs, union. Those are part of the 2% miscellaneous itemized deductions. I don't think too much about like what the 2% is or how you calculate that 2%. Just remember that the 2%, just put this in the 2% category in TCJA is essentially eliminated, part of TCJA. So you can't deduct those things. So it's asking us, what amount can they deduct? So if TCJA says that the 2% is the subject to the 2% of AGI limitation is no longer around, it's no longer valid, it's no longer eligible. This question is asking what amount is eligible, and the answer would be 0, right? None of it. You can't take any amount. You can't take any amount because of TCJA. Now, they threw in one thing that is key right here. So that's how you would answer this question. But if this question was phrased a little bit differently, just so you understand a little bit more about this, the $8,000 gambling loss right here is different. It's an exclusion to this. So that means that if the question asks how much can Cecilia take as an itemized deduction towards gambling losses, you could take gambling losses up to gambling winnings. So that means that if the question was asking that, how much can she itemize or potentially itemize, the answer would be $2,000 for gambling, because you could take gambling losses as an itemized deduction up to your earnings. So if she, for example, gambled $1,000 and then made $5,000, then she can only deduct up to the losses, $1,000. So just a heads up on that, the gambling losses is distinctive with this 2% rule. Question number 24. Trudy, age 64, single. Her 2024 wages were $19,100. Her permanently disabled child, Brandy, age 26, and her 10-year-old son, Juniper, lived with her the entire year. We use the following table down here to understand her earned income credit, the EIC credit. So earned income credit. That's what it's asking us about. Okay, so she's at 19,100, correct? So she's right here. This actually doesn't matter, right? She's either here or here. And then she has technically two children, because Brandy is disabled. She's a qualifying child. So the amount would be right here, 6,960. And let's just double check that one. Yep, 6,960. You'll need to understand EIC for the enrolled agent. Understand who qualify. Understand also the phase out limits for it, like the amount of money, the maximum you can earn to qualify for EIC for single, head of household, and married filing jointly. Question 25. Mr. Hardwood has an adjusted gross income of $50,000 in 2024. He donated capital gain property valued at $25,000 to his church and did not choose to reduce their FMV, fair market value, by the amount that would have been long-term capital gain if he had sold it. So this client, owned a property. It had a capital gain. The property was valued at $25,000. Instead of selling it, he donates it. His basis in the property was $20,000. He bought it for $20,000. He could sell it for $25,000, but instead he's going to donate it to his church. In addition, he made the following contributions: $500 to upgrade the city park, $1,000 to the Chamber of Commerce, $5,000 to a charitable organization in Germany. So calculate the deduction for charitable contributions in the year without regard to carry over or carry back amounts. So with charities, there are 50%. There are 50% charities, which are known as public charities, which are church which fall under that category. And with 50% organizations, that's what it's called. It's called 50% organizations. So just remember 50% organizations. And what it means is that you can deduct, it's a little bit tricky, but it's technically 50% of AGI cash, so in cash, Well, because of TCG, because of some changes, some recent tax changes, they increased it to 60% of cash. Sorry, 60% of AGI in cash. And then it's 30% for property. If the question was to a private foundation, it would be different. So there's a difference between a public charity and a private charity. Typically, a church is a public charity. So church is public versus private foundation or private charity. The AGI limits are different for contributing to a charity, public charity versus a private foundation. So it's asking us what's the total amount? So let's go in and calculate each one. So in our math, we have the first one, the obvious one, the 25,000. And then we count $25,000. Well, before we calculate the other things, we can only deduct up to 0.3 for public charities, 30% of AGI. So 15,000, which equals 15,000. So 0.3 of AGI is $15,000. So yes, he gave property worth 25,000, but because of the AGI limits, he can only deduct 15,000. So we include 15,000 in our math. $500 to upgrade the city park. That's included. So 15 plus 500. And then 1,000. So Chamber of Commerce dues are not deductible under the charitable contributions. And then same thing with a charity in Germany. It would have to be a US charity for it to count. So total calculation is $15,500, which is this answer right here. And to know this, you need to know the difference between a public charity and a private foundation. And then you also need to know the AGI limit. So that's key. So we're not saying 30% of $25,000 or 60% of the cash. We're saying 30% of the AGI for property, and then 60% of the AGI for cash. So that's key, is that the percentage is based off the AGI. And usually obviously they have to give you the AGI, so that way you know how to calculate the rest of these. Let's move on. Julie made cash contributions to her local chapter, the Society for Prevention of Cruelty to Animals. It's a nonprofit. She donated several times a year, but she paid less than $250 for the entire year. These are the only charitable contributions Julie makes during the year. What documentation must Julie keep and provide to the IRS upon request in order to substantiate her tax return charitable contribution deduction? So she's donating. If the IRS asks, can you show us proof? What kind of proof does she need to provide? So the first one, no documentation is necessary since the contribution is less than $250. That would be incorrect. You still need documentation. A self-prepared letter, also incorrect. You can't just prepare and say, client donated this much money to a charity and then sign it, like a self-prepared statement. That doesn't work. And then acknowledgement from the organization. Let's hold on that one. That one seems like the right answer. Let's hold on. An acknowledgement from the organization that she made those contributions. Okay, a receipt for the donation. Again, that seems correct. But so it's either between option C or option D. Now the rule is if it's under $250, then just the receipt alone would work. So that's the right answer. If it was over $250, then she would need acknowledgement. So typically when you donate more than $250, some charities just automatically provide you with the acknowledgements. But if it's over $250, you need the charity to send a letter to you from them saying, thank you for your donation of $1,000. And that's what you would need to provide the IRS in case they ask you for proof of the donation. Question 27, during the year 2024, Ted is self-employed and drives his car 5,000 miles to visit clients, 10,000 miles to get to the office, and 500 miles to attend business-related seminars. He also spent $300 for airfare to another business seminar and $200 for parking at his office, using 67 cents per mile. What is his deductible transportation cost? Okay, so deductible transportation cost. So there's one thing that you can easily remove from here, and that is miles to office. You can't deduct miles to your office. You only deduct miles to either clients or a workplace that you rarely go to. So that's kind of the rule. So you need to understand the mileage deduction rules. You need to understand those rules. So we eliminate the 10,000 miles, which leaves us in our math to calculate the total deductible transportation expenses. It would be 5,000 times 0.67 for 67 cents on a mile per mile. And then we add in $300 for airfare. And then what do we do with the parking? This is not deductible. Paying for parking at your office is not deductible, which only leaves us with these two right here. So then we go to a calculator, we type in 5,000 times 0.67, which is $33.50. We do $33.50 plus $300 plus $335, and it's $39.85. That's the correct answer. $39.85. Okay, question 28. Jim's W-2 comprises his AGI of $16,000, which of the following situations qualifies for the EIC if all other EIC rules are met in 2024. So it's asking you is essentially, could he qualify for the EIC? So Jim is eligible to claim the EIC if he files single and has no qualifying child. Potentially, let's put a hold on this one. Jim is not eligible to claim the EIC if he's single and he has no qualifying child. Well, that's not true. You could still qualify for EIC even without qualifying children. Jim is eligible to claim the EIC if he returned to the U.S. after 3 years of living abroad. This would be incorrect because you need to be in the U.S. for all of the year. And then Jim is eligible to claim in the EIC if he files single, is 18 years old, and has no qualifying child. This is incorrect. He needs to be between 25 years old and 64 if he has no qualifying children. If he does if he has qualifying children, then that would be he'd be able to, but without a qualifying child, he needs to be 25 to 64 years old. So that was eliminated, which leaves us with Jim is eligible to claim the EIC if he files single and has no qualifying child. So in other words, he's single, has no qualifying child, he could still take EIC because of his income amount, because of the amount of his income. And here's kind of the breakdown right here. So if you have 0 children, you file single, it's 18,591. And then married filing jointly is a higher amount. Of course, it's a higher amount. So in this case, Jim has 16,000. He has no dependents or qualifying children. It's 18,591 is the limit. His is 16,000, so he qualifies under this amount right here. And you have to be in this case, because he has no children, it's ages, he has to be 25 years old to 64 years old to get the credit. So understand the rules for EIC. Question 29. Carol, an individual taxpayer, received a Form 1099 dividend form showing a dividend from her global mutual fund that showed dividend income of $500 and foreign taxes withheld of $67. This is the only foreign source income she received for the year. Her income tax before any credits is $4,320. On which of the following forms may Carol elect to claim a credit for the foreign tax paid? So typically you have 2 options with foreign taxes paid. You can either get a credit for the amount paid, or you can get a deduction for the amount paid. So you can't do both. It's one or the other. And tax 101, usually a credit is better than a deduction. So, but the question is already leaning towards that. It's not asking us should she take a credit or a deduction. It's saying where does she take it? On which form does she use to take the foreign tax credit? So let's see the options. 1040 tax and credits, foreign credits. Let's see what else is there. Form 1040 Schedule B. No, not here. Not on Schedule B. Form 1040 Schedule A. Itemized deductions. It wouldn't be there either. It wouldn't be on itemized deductions. Typically, that's state and local taxes. We talked about SALT and local taxes here. That would be on the itemized section, itemized deduction. And then the right answer is Schedule 3. That's right. Just remember Schedule 3 for foreign taxes paid. So I would write out Schedule 3 equals foreign tax credit. Just remember those two. Right? Put these two together. It doesn't go on 1040. There are other credits that you'll see on Form 1040, but actually, the Schedule 3 foreign tax credits flow through to 1040. But the question is asking you, where do you put foreign tax credit? On which form? You don't put it on 1040. It flows to 1040. And then we have one more question left. A taxpayer is a cash basis taxpayer. During the year, he paid the following medical expenses for himself and his daughter. Who is the dependent on his return? That's key there. So typically you can deduct. Let me rephrase that actually. So when you consider how much you can deduct for medical expenses, let's just say we have a pot right here. It's called potential medical expenses because there's rules to the medical expense deductions. What you can add into this pot right here is either expenses for yourself, your spouse, or a dependent. Now let's count what's included. So $310 for glasses for his daughter and for himself. Yeah, these two count right here. So we include in our math $310 plus $290. You include these two. $650 for a dental root canal. Yeah, that counts. So we add $650 here. So far we have $310, $290, $650. $900 for emergency services, of which $700 was paid by insurance. So he spent $900. The insurance company gave him $700 back, or $700. They paid for that. So he can only add $200 to this pot right here. The difference between $900 and $700. $1,250 for braces, which he charged to his credit card in December and paid in January. So in this year, in the year of question, he essentially swiped his credit card, $1,250. They're typically, I wouldn't put too much thought into this. Think about it from the dentist standpoint. Like you have a client, and you're the dentist, you have a client in front of you. One client gives you $1,250 in cash. The other client swipes your credit card and gives you $1,250. The dentist received $1,250, right? So don't overthink it. It's essentially the same thing. He spent that day $1,250 that day. So we add in $1,250 right here. $500 for prescription drugs, that does count. We're used to $500. $2,200 for cosmetic. Guess what? That doesn't count. So we cross out cosmetic, which leaves us with this math right here. Now let's add all this up. 310 plus 290 plus 650 plus 200 plus 1,250 plus 500 is $3,200 is the total amount before limitation. That's key right there. The correct answer is 3,200. Now, to give you a little bit more information about before what that means before limitation. So if there was a limitation, if the question is asking how much can he actually deduct as an itemized deduction, then with the second step, so the first step is you calculate the qualifying expenses, which we just did, which is 3,200. The second step is we remove the 7.5% AGI floor. So that means that if this client's income, his AGI was $100,000, we do 7.5% of that. Remember, 7.5% goes with health insurance or with medical claims, medical expenses. So that's $7,500. That means the first $7,500 is excluded. So that means that all the math, if this client made $100,000 and the question was asking us how much could he deduct, the answer would be zero, because the first $7,500 is essentially it's a floor. He hasn't even met that floor. Essentially, this becomes a zero right here. It's none of it is deductible. So just look out for that. You might see questions about the 7.5% floor. If it asks you considering the 7.5% floor and they gave you the AGI, then you'll need to solve how much is actually deductible on Schedule A, how much you can actually itemize. But it's saying before limitations, so the correct answer here in this case is $3,200. If I do any more exams in the future, I'll also post videos on those, on how to pass those exams. Feel free to connect with me. I'd like to meet you, talk to me, connect with me on LinkedIn. There's a couple scheduling links in the notes below. Feel free to reach out to me. Thank you.
To learn more about what we do and how we can help you grow more wealth, please visit www.finassetprotection.com. That's FIN, assetprotection.com. The topics presented in this podcast are for general information only and not for the purposes of providing legal, accounting, or investment advice. On such matters, please consult a professional who knows your specific situation.